Welcome to CoinShares Talk, back to school for CoinShares Research team. Hi everyone, I'm happy to find you again on this live stream. How are you doing?
All good, thank you. Never a dull day in crypto, is it?
Yeah, long time for this live stream. And before going into crypto specifics, I think we had to go back to the big picture and what happened this week. And it comes to you, James, with the Fed meeting that happened yesterday or 2 days ago. I don't remember. On yesterday, actually,
Yesterday, yes.
with the first rate cut since December, actually. So it was a big news, but markets remain flat. So what's your analysis for after this Fed meeting?
Yeah, I mean, I think it's first of all talking about why, this is a podcast around crypto. Why talk about interest rates in the US? And, on a very fundamental level, Bitcoin is trading like a store of value. And like many other store of values, be it treasuries or gold or others, when interest rates move, it has an effect. And I think that's really encouraging because Bitcoin definitely moves now. And when you see interest rate sensitive macro data such as CPI prints or employment payroll data, it tends to have an immediate effect on Bitcoin. So it's telling you that the market now is treating it like a store of value. So when interest rates rise, it tends to make Bitcoin less attractive to assets that yield something such as US treasuries. So people tend to sort of sell things like Bitcoin and gold and buy treasuries. Now that's probably why the Bitcoin bubble burst in 2022. It's suddenly the Fed was super hawkish,
Hmm.
and in other words, wanted to raise rates. Now we're at the other side of that, where the Fed cut last year, an emergency rate cut of 50 basis points, and kind of stopped there. And the first time since the election, since Trump was elected, despite Trump's moaning about the whole thing, the Fed has been very worried about the transitory impact of inflation, so haven't cut interest rates. But over the summer, it turned out that actually the payroll picture was looking pretty grim in the US, and as a consequence, it became no surprise that the Fed would cut rates at that point. Um, and so, yeah, it wasn't really a big surprise that the Fed cut rates yesterday, but the initial reaction was actually quite supportive. The interpretation of it was quite dovish. I expect, a quite weaker sentiment towards the economy. The Fed was expressing, but sort of midway through, there was a lot of mentions about their worries about inflation. So people have been coining this a hawkish cut, which I don't think is actually true. But I suppose they're just sort of adding in a sort of a hedge, I suppose, a get out of jail free card sort of thing by just continuing to mention inflation remains a big risk. I don't actually think it really does. We should have probably seen inflation impact now from Trump's tariffs, but we've not seen a huge amount. But we're certainly seeing very weak payroll numbers, and the outlook now after the meeting is for we've seen a change from just another quarter a percentage point rate cut to now most people in the Fed believing it would be another two rate cuts, so probably one in October or November and one in December. So that, in my view, is quite a hawkish outcome, and I do think it really provides a supportive backdrop to crypto prices. Although just looking at prices at the moment, they have moved a bit, but not a huge amount. But I do think longer term, and in that I mean, so 2-3 weeks, a month plus, it will likely to provide quite a sort of supportive floor for Bitcoin prices.
What would it mean if the Fed move? You already started to answer that, but what would it mean for crypto, especially compared to equities and gold, if the Fed moves toward over multiple cuts this year?
That depends slightly. Let's say we're in a situation where the employment picture continues to deteriorate. That's quite a bad outlook for the consumer, or the consumer's looked reasonably robust so far, but that would be quite a bad outlook for the consumer. And I think in that kind of scenario, equities would not do too well. But at the same time, it would be sort of seen as a kind of a bit of a mistake by the Fed that they waited too long to cut rates. Certainly, Donald Trump feels that way. So cutting rates now was probably the right move. Perhaps I believe they should have probably cut a little bit earlier. So yeah, if we see the US tip towards recession, then I think equities are really going to perform quite poorly, but Bitcoin would do quite well because it is this kind of monetary policy hedge, a bit like gold in that respect.
All right. We also seen strong but volatile inflows when it comes to crypto ETFs, Bitcoin, ETH as well. What's driving this stop and go pattern, according to you?
Well, certainly price wise, just looking at my data here, there was a little bit of bearishness. I think people were getting a little bit worried the Fed wasn't going to cut rates. And so we did see, a few weeks ago, we saw a little bit of outflows from Bitcoin, about sort of $1 billion of outflows, and a bit of outflows from Ethereum too. But I think this has to be put into context now. With Bitcoin year to date, we've seen nearly $33 billion of inflows. So that is telling you there's a very positive sentiment expressed towards the asset. And month to date, so far $2.2 billion into Bitcoin. No, actually, sorry, I made a mistake. I was looking at just iShares then. 24.3 billion of inflows year to date, and 3.5 billion month to date. And just to put that in perspective, Bitcoin saw 41 billion last year of inflows. And just looking at the market in aggregate, looking at Ethereum, which has had like a massive turnaround in fortunes, it's seen $12.3 billion of inflows year to date, and that compared to 2024 was 5.3 billion. So absolutely smashing all prior year records, and that brings in aggregate the total to nearly $40 billion of inflows year to date, compared to last year in total 48 billion. So looking at doing the maths, we're kind of on track to match, or if not beat, the inflows we saw last year. So I think this is actually, we shouldn't be looking at the recent sort of lackluster price performance as something that's quite the negative. I think the sentiment's very much there, and I think the price will follow now.
As you mentioned, the summer. Yeah, Chris, go ahead.
Yeah, just to add a little bit there is that I think if you've been in Bitcoin for a while, maybe you've grown accustomed to harder upswings, so to speak. I just want to make some points that I'm writing about currently. There's this like kind of persistent narrative that there's this like illiquidity crisis happening in Bitcoin. We're running out of coins on exchange. Coins going into like the 5 or 7 year plus hodl band just keeps increasing, and the kind of the implicit argument there is that we're somehow going to run out of coins, and therefore we're going to take this like really hard melting up to the upside type of move. And I've it's just not the right way of thinking about it, because with the price doubling, if the coins on exchange goes down by 10% and the price doubles, then exchange liquidity has doubled nearly, minus 10%. And if the amount of coins going into the 7 year plus band or whatever is like reaching 600 or 700 billion or whatever, the coins that are not on in those bands, coins that are actually considered liquid, they're now reaching like 1.5 trillion. So what I think is I mean, there seems to be this like lackluster price development, but we have to remember now how big Bitcoin is becoming. Multi-trillion-dollar asset now. The amount of flows that we need to keep this kind of relentless growth going up are huge. And like James mentioned, we're seeing those flows. The US is carrying a lot of the burden here, and pulling the price up with it. But it is pulling the price up, and that is what's generating new liquidity. We've seen too that there's been quite a lot of old coins coming back into circulation as well. Some coins fall into liquidity, others come back into liquidity. And it's just a matter of, we have a wall of around 11.5 million coins that are on private hands. And at certain price levels, some people are going to start thinking, man, this is the time for me to be a billionaire, in dollar terms. Let's go. And we have to just grind through it. And I think James is absolutely right that the sentiment is there. We're grinding upwards. It's just probably not going to be this type of like face melting upside that people kind of hope for, because there's so much liquidity to actually get through.
I think Bitcoin's changing as well. Back in 2018, it had 130% annualized vol. I'm just looking on Bloomberg now. It's 27% annualized vol. And also, Chris talked about hodl bands and UTXOs. If you look at the number of people holding Bitcoin for 155 days or longer, it's gone from 30% in 2018 to 72%. So people are just buying and holding Bitcoin, and that's perhaps explains part of the reason why the volatility's come down. And I think it's changing. People treating more like a store of value, becoming more gold-like in some respect, but crucially with the growth component, and that's what distinguishes it from gold. And I think for that reason, like Chris said, we shouldn't expect to see this kind of huge melt up or huge price spikes like we've seen in the past.
Let's talk a bit about ETH. As you mentioned, James, it's been a big summer for ETH. You must have been pleased, Luke, by the way. And I think that we can say that the catalyst was maybe Tom Lee and obviously Joseph Lubin and their own treasuries. Yet, since the beginning of September, the sentiment seems to have shifted a bit. Are you all still bullish about ETH? Did something change recently for Ethereum? What's your opinion on that?
Yeah, so I mean, personally, and some people might disagree. I actually wouldn't give that much credit to Tom Lee and Joseph Lubin for the asset itself, for the asset's appreciation. I think they obviously catalyzed the Ethereum treasury companies, which I'll get onto in a second. But I think the main driver, especially on the flow side, have come from the establishment of the Genius Act, which we could spend a lot of time talking about, but in a summarized way, kind of it creates this landscape for not only stablecoins, gives them sort of a regulatory framework to operate under, but also the idea of tokenized deposits and how that could extend onto public blockchains and their interaction with, let's say, tokenized money market funds, tokenized treasuries. When we think of those markets on public blockchains, stablecoins, it's around 280 billion. I think around 160 billion, give or take 10 billion of those are on ETH. So obviously ETH has the majority of the rails there. And when we talk about tokenized products, whether that be private credit or the products I just mentioned, that's a $30 billion market, and that's 60% hosted on ETH. So clearly the market, rightfully so, has seen ETH as the main beneficiary of the Genius Act. So I think that drove a lot of momentum, price-wise and flow-wise, of the 13-ish billion of flows that ETH has seen year to date. I might be wrong on that number. I think 11 billion of those have come in the last 3 months. So you also have to consider that there's been a bit of a lull because ETH went from, let's say, 2,600 to 4,800 in quite a quick space of time. There was maybe a bit of an overshoot of expectations as to how quickly these things are going to develop. There's a speculative premium on top of what was genuinely a fundamental move for the asset. So I think that's normal for it to kind of take a breather, and I think it seems to be stabilizing somewhat in that 4,300, 4,500 range. And then on the treasury company side, I think you know, you look at the NAV premiums, they're nowhere near what we've seen for some of the Bitcoin treasury companies. And I think, in my view, it's pretty simple. These are the most vanilla treasury companies you have. They are just doing straight at-the-money equity offerings, essentially straight dilution. So it makes sense for them to trade at a premium, but what that premium is, I'm not entirely sure. I think definitely less than 20% is a sensible thing. So it's not like they're failing. They just, you know, when you talk about convertible debt, which may or may not become equity, or it might come at a discount or a favorable coupon 2, 3, 4 years from now, the premium you see now is kind of discounting that future dilution, right? So the dynamics are a bit simpler. So definitely still bullish on the asset. I think from a technical perspective, it took a breather. I would expect it to come into favor again. We also have to consider capital can only, you know, it's not infinite. So we look at something like Solana, it's kind of having its moment right now. It had the recent Alpenglow update. The SEC filings are due mid-October, so there's clear catalyst there. I think rotations happen in crypto, but I think fundamentally Ethereum has seen quite a positive development this year.
I just to follow up on that, I think it's so interesting to see this looks so much like classic like alt season, if you will, with like successive rotations. You know, first everyone was like, oh yes, Bitcoin's been doing great. Rotate into ETH, ETH Bitcoin pair outperforms. Rotate into Sol, Sol ETH pair outperforms. Where does it go next? Do we go further down? Do we rotate back? I think this will kind of determine like what are the blue chips, right, so to speak. Like who gets to be in the rotation cycle. This seems pretty trader driven to me, given the successive outperformance of these things. It'd be very, very interesting to watch.
We may see the next blue chip in the future crypto ETF. Like the SEC just outlined a new framework to ease and accelerate the issuance of crypto ETF. How do you all think significant is this for the industry, and what does it change for issuers like us?
If I may, unless somebody wants to jump in, I think it's really good in my view. One of the concerns I had looking at the fact that there are 95 open SEC filings for single asset, mixed asset, you know, not to be too kind of I guess brash, but a lot of them are probably worthless tokens, and they're probably somewhat linked to founders who are looking for maybe a liquidity event or something of that nature. Yeah. Which concerned me, because when there was a change in SEC administration, it could go down two ways. One would be, you know, let's just green light everything. We're now crypto friendly. That means we can just allow anything. The other one was thinking like, okay, maybe they'll set some ground rules as to what is or isn't allowed. And this kind of speedy framework is very clear in the fact that, you know, these kind of pre-approved, let's say, tokens have to have, you know, significant futures markets. So we're talking Coinbase or CME. That's not going to apply to a lot of these tokens, which will have to go through the full scrutiny and, in my view, have less of a chance of being accepted. So I think it's a really good move. I think it allows a clear pathway with less bureaucracy for the assets that probably do deserve to be financialized and open to a wider range of investors. But it also kind of leaves the SEC the space to go, actually, you know, this small cap coin that's 60% held by some VC firm, maybe we won't to approve that one. Maybe I'm being cynical, but that's my view.
I mean,
Alex.
playing a little bit of devil's advocate here, you know, who's going to decide what's acceptable to be listed or not, right? I think, you know, whatever's very high risk in terms of alternative coins, etc. I think, you know, whoever understands that, you know, those products, those protocols, they already have an access via, you know, in the way of crypto native wallets, you know, the ecosystem that already exists, and I don't think they would need to tap into vehicles provided by, you know, listed in the Nasdaq or NYSE or whatever. So I, in my view, I think there's a little bit conservative, but I think the bar should be quite high for those listings, because once it goes into the mainstream, I think it just there's a lot of potential for pain, and these are assets that retail doesn't understand. Even some retail some institutions will not understand them. So I think the level of risk in those assets specifically, I'm not talking about the high liquidity, well-established coins. I'm talking about market gaps of like $100-200 million.
Yeah, it makes sense as well. Well, where are we right now? Well, speaking about new products, what is the timeline according to you if you had to make a bet before we see new products?
Well, I think the closest deadline, if I'm not mistaken, is the 10th of October, which is I think whatever it is, 275 days after the first Solana filing, which I believe we're somewhere in the mix there. I'm in no place to say whether those will be approved or not, but I think what has been previously a good indication of approval has been dialogue between the SEC and issuers. We didn't see that for a long period of time for even Ethereum, and then once they started dialogue, that's like an indication of, okay, we're listening. Here's what you need to change on your filing. You see the updated filings. So I think the chances are looking pretty good for Solana, but obviously none of us here sit at the SEC, so we don't know. And then after that, I think there's many that are successive after that. So mid-October, I think there's some XRP ones, even Litecoin, some multi-asset ones. So Solana is the first, as far as I'm aware, and then it could be in November where we have 10 plus ETFs, some of them repeated assets, but maybe 3 or 4 different unique ones. That's what the timeline looks like.
Luke, you mentioned a bit the ETH treasury companies. We haven't talked about Bitcoin treasury companies yet. This summer, we've noticed that Michael Saylor spaced way more its Bitcoin purchases, and stocks of some crypto treasuries are failing, especially Nakamoto, for instance. James, Matthew, Alex, Satish, everyone. Actually, what's your analysis regarding the current landscape of these Bitcoin treasury companies?
I mean, I think it's quite simple. The demand's not there. I think we had a period, May, June, July, in which markets were extremely frothy. You had companies with MNAVs of like 7 times, 10 times, and obviously that was never going to be sustainable, right? Some people were calling the treasury companies boom like the altcoin boom of this cycle. And I think they're right. I think there was a lot of hype around that. Michael Saylor was doing a lot of marketing, a lot of talks and getting a lot of attention. I think Bitcoin Vegas as well helped with that. And it's quieted down, right? It's calmed down quite a lot. My strategy, for example, went from 2x NAV in May to 125 now. You have Metaplanet going from 3x in May through 7x in June, and now 2x now. So that's quite a big difference, right? Not that these companies have fallen as much in terms of market cap because they have issued new equity, they bought more Bitcoin, so the value lost to investors is not as high. We actually are shareholders in a few of these via the ETF. Yeah, I think there's a healthy correction. I think that the way it was going could not go, and there's not as much demand. But I think now it's an opportunity for companies to be able to think carefully about the strategy that they want to play in this industry. They have lots of instruments to tap into. I think there could be an opportunity right now to look carefully into debt instruments. Convertible debts, you are still able to get low coupon rates. Obviously, zeros are ideal in this kind of strategy. But even Metaplanet has been finding ways to monetize their Bitcoin holdings, and I think that's quite clever because provides with some leeway to change your capital structure a little bit and not dilute in shareholders as much. So and you also seen the number of companies coming to market with Bitcoin strategies, treasury strategies, and other crypto strategies reducing quite drastically, right? I think, we were seeing 1 or 2 a day in the height of summer, and now, we're seeing 1 or 2 a week. Again, I think this is healthy. I think this is how it should be. Otherwise it would dilute capital, and I don't think was going to be a lose-lose situation. In terms of MicroStrategy buying less, again, it's probably they probably don't want to over leverage the balance sheet. They're issuing a lot of the preferreds now. I think they made a relatively big purchase recently, more than 1,000 Bitcoin again. They were in the hundreds before, and I think it's just like being opportunistic and making better use of your capital structure, share price. They changed, they amended their capital issuance strategy to include debt issuance below MNAV. When the MNAV hits below 1.2, I think, something like that. So yeah, it's maturing, and I think it's perfectly fine. However, I do think that with cutting interest rates, weaker dollar, people might wake up to this again, and you might see maybe a little bounce, perhaps not to similar levels that we were seeing, but MNAV's going from 1.5 to 2 again. I think that's perfectly possible.
Well, I would add, there's potentially a lack of quality companies engaged in Bitcoin treasury action, or adding Bitcoin to their treasuries. And Metaplanet and MSCI, they are companies we invest in, and it is to, I think, express that Bitcoin treasury theme. But we've been quite excited by some smaller companies, such as Semler Scientific, but generally higher quality companies are investing a lot less in Bitcoin. And it's perhaps, I think for some of these Bitcoin treasury companies, it is almost the only thing they do now. Certainly in MicroStrategy's case. And I think that sometimes is a little bit hard to rationalize. That's all there is to the company. There's no diversified revenue stream. And so I can understand why people are getting a little bit cautious in the space.
I think so. Satish and I ran some numbers the other day on, say that 90% of the Bitcoin treasury companies went under completely, had to sell all their coins. Like, would it have much of an impact? And the answer is no. If you go outside the top 15, top 15 holds 90% of the coins, more. MicroStrategy holds 65% almost. To me, it's, if you're going to be a treasury guy, obviously everyone's like riding the wave right now. It's kind of like riding the blockchain wave, like back in 2017. Like any company that put blockchain in its name just got like an equity, like a boost to their equity prices. And I think a lot of companies are doing this right now. I think if you're going to be a Bitcoin treasury company, like a proper one, then you should probably only do that. And if you're going to be like a small company just putting some Bitcoin on your balance sheet, I mean, okay, yeah, by all means, like go ahead and do that. It's probably not going to do a ton for you, realistically. So I feel like there's probably going to be a divergence. And I think the companies that have some sort of kind of regulatory or currency moat around them are probably going to be the ones that basically capture the lion's share of their local capital market are probably going to be the ones that do okay. And the rest, I'm like, what are you guys even doing? You better hope this works out. And it probably won't.
Speaking of equities, we have also seen a wave of IPO recently related to crypto. Circle first, then followed by Gemini, eToro on bullish. Some of them have been like heavily challenged. How do you explain this bearish trend again? Is the market getting more rational? Yeah, what's your opinion on that, Tim?
I'll start. The timing of these IPOs, I don't think could be any better to these companies. They were able to raise capital really well at very, very attractive markets. May, June, even July were incredible months for IPOs in the US for crypto-related companies. There's been a little bit of a hangover with that, and I think because valuations were super high, and the market was so heated up. I don't think these are bad businesses by any chance, and I think actually they're very good, and it's very healthy that they list, and there's more transparency in this industry. I think perhaps if FTX were listed, it will not have happened what happened back 2 years ago, 3 years ago. They just were listed with very high prices, and probably a lot of people made a lot of money out of this. Founders, early investors, but they nailed the timing. They just literally nailed the timing. I think that's pretty much what it is.
Satish, do you share the same sentiment?
Yeah, more or less. I mean, I think it kind of got caught up with the Bitcoin and crypto treasury summer as well. It was also IPO summer, and especially as it relates to Circle's IPO. Just a few weeks before the IPO, there was talks of Coinbase and Ripple even entering into a potential sort of acquisition of the company, as well as Cathie Wood and a few others, being part of the IPO deal as well. So that kind of fueled a lot of momentum, a lot of hype around Circle, and that was massively sort of mispriced. And you saw the reaction, almost 10xing in a matter of weeks before sort of reality settling in as it relates to its fundamentals. So I think that's kind of been the case with some of these recent ones like Gemini, bullish as well. They're essentially just exchanges, and I think because of, let's say, unfortunate timing compared to June or July, I think the valuation premium on top of the IPO pricing has just not been there. So yeah, I kind of share the same sort of sentiment, but at the same time, it broadens out the universe, it increases the transparency, as Alex said, and it essentially sort of improves our industry. So and it also encourages additional business lines to be explored between exchanges, between banks, etc. And it's all part of the broader act of improving regulation, the transparency of consumers, investors, and I think altogether it's ultimately a healthy thing.
I think one bright spot of equities and crypto markets over the summer has been Bitcoin miners, and I think that's been very highly overlooked. You've had Iron, Cypher mining doing really, really well. I know that it is probably not on the back of Bitcoin mining. It is on the back, obviously, of AI HPC and the deal that TeraWulf had. They went up 70% once that was announced. But these are going to become. I think mining and AI are going to become intertwined and ancillary businesses, and quite symbiotic of each other. I think they can use energy in a very clever way with Bitcoin mining and AI together, in terms of intermittent loads and all things like that. So yeah, I think this is another part of the industry that that investors are waking up to again, and seeing that there could be very interesting returns to be made with this power infrastructure that effectively Bitcoin miners are. So I think that's been overlooked, despite the hash rate growing so aggressively. Bitcoin miners are finding other streams of revenues, and I think for investors that is extremely interesting.
I'd like to address stablecoins now. It's been like the hottest topic of the past year, and it's likely that it will remain the same for the coming one. This landscape has been constantly moving. Recently, Tether announced a new and compliant stablecoin, USAT. We have seen Circle being challenged by the new kid, the new sheriff in town, Hyperliquid, and making big announcements not to lose this market. In the meantime, we've seen ESD gaining traction, USD1 that has launched. what is changing? Who will win with this market? And should we expect like multiple winners? Maybe Matthew, maybe Luke. What's your opinion on that?
Yeah, I can start unless Matt, if you want to go first, I'll jump in after.
Go for it.
Yeah, no. What I would say, I mean, I think, stable coins as we know them, talking specifically like USDT, USDC, we know how they function. They facilitate value transfer on blockchains. They facilitate trading on exchanges. The winners of those markets tend to be the liquid ones, the network effect that they bring, and those will continue winning in those markets. But I think what's interesting about stable coins as we don't know them, and what I mean by that is all these recent stablecoin developments, is that they're likely to proliferate in multiple different ways. And so you think of something like, there was talks that Amazon wanted to create their own payment stablecoin. You can think, to make a kind of comparison, like people call Starbucks a bank somewhat because people load up these gift cards and they load up their apps, and the money that Starbucks hold on behalf of them means that they have a lot of kind of capital efficiency that they can leverage in multiple different ways to earn extra revenue. You can think of that on Amazon. If they had a stable coin and they were rewarding loyalty for people who hold money through this Amazon coin that allows Amazon, who moves billions of dollars a day, to leverage that. So it's going to proliferate in different ways. And so people can be individual winners. But I think when we talk about market winners, you have the trading side, which, again, to reiterate, I think liquidity, network effect is going to continue winning, because why wouldn't it? If I'm going to trade something, I'm looking for liquidity. I'm not looking for somewhere where I might get liquidated on a bad wick, or if I'm trying to lend or borrow on a crypto rail, I'm looking for a place that has a lot of TVL. Other ways where we don't know where they're going to proliferate is like on the banking side. Like people talk about the monetization of payment stablecoins or tokenized deposits, but they also lack to consider, and it's difficult to see to visualize this, is like how many of the legacy banks that incorporate these rails will not monetize them but save so much money on the compliance audit side. The cost cutting could be in the billions. I don't know. I'm not an expert on the subject matter, but I think it's going to be a while before we realize who can win and how. I don't think it's the winner takes all market. I think that it's the people who can leverage the tech in the best way to either monetize or become more operationally efficient that are going to win individually. And then the stable coins as we know it will continue to be won by the two giants, just because that makes the most sense in my view.
I think it was well covered by Luke. Covered a lot of things that I was really going to say, but I think the stable coins will continue to compete on liquidity. Compliance is, I think, an increasing area. And I think that's kind of what we're seeing with these different types of issuers as the U.S. set guidance with the Genius Act on how stablecoins will have oversight and different bankruptcy proceedings, and just give specifics for how they'll operate in the States. I think it's interesting and very interesting to me that they have really invited Tether onshore with this new U.S. Is it USAT? Is that what you said?
Yes,
yeah, that's right. I'm sure I got the acronym right. But Tether's been predominantly offshore markets and has dominated it for years and years now. So I thought it was pretty interesting. I invited them onshore, especially with how strong of a presence Circle and USDC and partnerships with Coinbase as well have in the States, as it kind of felt like in the past that was going to be the chosen one. But now I think they're all kind of jockeying for market share state on the States side. But I agree with Luke. I don't think it will be a winner take all market, because I think different jurisdictions will decide to regulate stablecoins differently. I do think, because liquidity is a strong component of competition, that these things will converge over time. But as well as I think another piece of competition is integration with existing payment rails and payment systems, right? As it just becomes more seamless for businesses and banks as well as retail participants. So I think it's an active space of competition. I think we're just kind of seeing the early days of it playing out post Genius Act on the state side.
I would love to see what this looks like in the end for the consumer. Like, are you going to know whether you're holding an Amazon stablecoin or a PayPal or like a Facebook stablecoin? Or am I going to be able to send my Amazon stablecoins to like Meta and just have them seamlessly transferred into Meta tokens? Are they going to compete on like giving me rewards? Is Jeff going to be like, hey, you get 2% if you hold your stablecoins on Amazon, and Zuck is going to be like, oh, you get 2.3 if you hold them on Meta? You know, are the merchants now, because the rails to run your own currency and run your own money operations are so cheap now, are they just going to properly become banks? It'd be very interesting.
Speaking of this, and sorry for the follow-up question out of my heart, but do you see any market fit for, the new stablecoin specific layer one that have been recently announced? Circle has announced ARC, Stripe has announced Tempo. Do you see any market fit, or do you understand really the needs for them?
I think this is really interesting because when we saw Circle IPO internally, we were kind of, I thought, oh, it's launched at quite a high valuation, and then even after that it ran whatever it was, 600%, and I was just kind of scratching my head thinking, they make 95% of their money from the treasuries they hold. If we expect rates to come down anywhere in the next 3 years, and that basically cuts their revenue significantly, and the supply would have to grow proportionally to that. And that's the way that they make money. So I was thinking, what's the optionality here? Why are people giving it such a premium? Obviously, now in hindsight, some of that was, or the majority of that was speculative, but now it becomes clear. It's like, Circle doesn't make money when I use USDC on Ethereum. Circle doesn't make money when I put it on a DeFi protocol on Ethereum. So what if Circle takes the rails and now integrates, on the institutional side? What if when people want to integrate USDC, they integrate the blockchain that Circle runs, and they take 1 BIP, whatever it is on that transaction? Then the monetization for Circle as a business not only comes from the treasuries they hold, but also from transaction fees or XYZ thing. So clearly the regulatory side has shifted to the point where Circle is now able to explore these ideas. From their perspective, it makes total sense. I'm skeptical on how much adoption that will have from the crypto world as we know it, but on the B2B side, I mean, why not? They're not looking to, do crypto in the way that we do crypto. They're looking to leverage the operational efficiency. So I think it makes total sense from their perspective. I think we need to see how it plays out.
I think it makes sense from the government's point of view too. They don't love that you're sending transactions on His Excellency Justin Sun's blockchain, and you have to go and ask him to get your transactions reversed when things go wrong. I think it's much easier to just run your own blockchain. And I think this just, I commented on this last week, I think this just shows that transactional blockchains are a dime a dozen. The blockchain is not that interesting, especially if it's private like this. It's just like a rail. And what the competition is going to be all about in the crypto market is the monetary properties of the token unit. I worry a little bit about what this means for crypto platforms that has fee growth as its fundamental investment case, whereby in order for value to accrue to the token holder, they need a robust fee growth. They really now need to differentiate themselves based on either complexity or grabbing market share early and keeping it, and kind of being the network, or they need to literally just go out there and be like, yep, this is where you can do whatever you want. And so are you willing to pay or not? It'll be super duper interesting, because if stablecoin volume all now goes to these all other random blockchains, that's quite a bit of fee spend that just goes away.
Matthew, you wanted to weigh in?
Yeah, this is scary for Bitcoin too, by the way, in that, stablecoins are taking a medium of exchange volume and the fees that come with that.
Matthew?
Yeah, I think these things aren't so dissimilar to private card networks like Visa and MasterCard today, and really not that dissimilar even to ETH L2s that have single sequencer run by single companies. At this point, the oversight and compliance becomes super easy when there's just one entity running it, right? But also, from the stablecoin issuer's perspective, if you can extract all of those payment processing fees, why wouldn't you try? Why would you allow these companies running the single sequencers on ETH L2s, or Visa, MasterCard? Why would you want these other payment providers essentially to extract those fees when you could try to compete for those fees? So I think that it will be interesting to see if there's how the market differentiates these things, and where ultimately settlement follows. But I mean, is it just, you have to ask the question of, are we just recreating this model of intermediating banks and payment processors and fintech apps, and it's all just going to settle down in the same types of ways, just with different names? It's an outstanding question, I think. There's certainly go ahead, Chris.
And what's the real use case? Like the only hardcore successful stablecoin has the use case of demonetizing crappy fiat currencies outside of the developed world. Is there a huge use case for stablecoins inside of developed countries where we have extremely good financial infrastructure already? That'll be super interesting for me as well. If you can actually get people onto these rails, that'll be an interesting future.
I think the dominant use case, I think, will continue to be basically onboarding offshore markets onto the dollar via stablecoins in the most seamless, most accessible fashion that there is. That's been the story of stablecoins thus far, and why they've 10x'd in as a market, right, in the last 5 years. But stateside developed markets, it's, I think, really just the stepwise efficiency gain alongside this kind of narrative and guise of innovation that will bring people to it, where you can basically have different players cooperate, and not T-2, but minutes.
I wonder, like, taking a bit of a different kind of tack on this, I wonder if stable coins will start offering a yield. Basically it is a way to own US treasuries, but you don't get the yield. And I think eventually people are going to wise onto this fact. I mean, Tether is making substantial profits from basically providing a dollar asset, but not returning the yield. How long can that really go on for? And maybe that's where the competition starts hotting up, when one of them is a first mover and says, okay, I'll give you a portion of that yield. And
but
it's interesting space that's never happened so far.
Yeah, but it's because it's not allowed in the US. I don't know which act it is,
and in Europe as well, actually.
Yeah, you're not actually allowed to give yield, because the regulation is written so as to not just completely throw the banks overboard.
Yeah.
And so it's written to protect them. That's not to say that they can't offer you something else that's not yield, but yieldish.
I think there is a play there with governance token, especially with Plasma that is coming. So for those that you still don't know, Tether is about to launch its own Bitcoin sidechain that is Plasma, and is supposed to secure also USDT rails. And there is a governance token associated to Plasma, which is XPL. So maybe Tether won't, reward users with USDT yields, but maybe through the governance token. I think there's something to explore that, and Plasma is supposed to launch next week. So yeah, we shall see. We shall see in the coming days.
I think that we're seeing the yield will come through endpoints as kind of a roundabout way. You hold your USDC on Coinbase, and it's not a direct pass through of the yield that they earn from treasuries that back USDC, but it's for marketing purposes, right? And you can class these types of give backs to holders in different ways to allow it to be compliant, and I think that's what will amount to. I think also the market hasn't necessarily as much demanded, for something like Tether, a yield in the past because, it is enough that it's liquid and providing dollar exposure globally, and that that is a 0 to 1 benefit for most of its users in the first place, and so that there hasn't really been that much of an ask for yield. But I think as developed markets start to onboard into stablecoins, maybe there's more of an appetite. That being said, the interest rate you get on your checking account at a normal bank is trivial to none. So maybe not. So I think it's going to be interesting to see how that plays out. Certainly.
Maybe you get Amazon reward points, or like Meta reward points or whatever, and that's how they start like competing to give some of the yield back. Right, to James's point, that could be it. It's like Matt says, there's probably ways to not have it be yield, but still getting you the money from the yield in some way, and that could be a competition point.
Because everyone wants Bezos bucks and Zuck bucks.
Zuck bucks.
Guys, I offer you to continue this discussion for the next one. It was great having you guys for this for first of this season, and see you in a month. Have a nice one. Take care.
See ya. Thank you. Take care.
Jeremy.